The US economy right now is the wealthiest economy that has ever existed in the entire history of humanity. The GDP of the United States is like 27 or 28 trillion dollars. There is not a single country that has ever existed in the entire history of civilization that was this rich. In fact, if you even take a look at the GDP per capita of the United States, it is one of the wealthiest countries in the world. And logically, it should be like an average American should have a far better life than anyone else on the entire planet. But let's be honest. If you have been traveling all across the globe, there are a lot of countries where the quality of life of the average person is significantly better than the quality of life of the average American. So what exactly is happening? Why are these numbers that are being reporting to us does not reflect the true reality of life? Let's take a look at a very specific example. This is the list of the countries by GDP per capita. And at the top of the list, we have countries such as Monaco, Luxembourg, Switzerland, Ireland. And it makes sense why these countries are so insanely rich. They are very tiny countries with very small tiny population of 3, 4, 7, up to 10 million people, and they might have natural resources. They might be located in such a way where every single ship must stop there in order to refuel, so they have some of the largest ports. They might be top travel destination, or they might simply be a tax haven for companies that would come there, such as Ireland. The average Irish person is not rich. It's not that rich. I mean, it's rich, but not that. But the GDP per capita stands at around $100,000. Why? Because it's a tax haven for US companies that operate in Ireland for them to reduce taxes. But if you take a look at this list, there isn't a single major country in the top 10 or the top 15 other than the United States, where the GDP per capita is around $86,000. So why is the average American is not that rich? Why is average American his quality of life is far inferior compared to many European countries? That doesn't actually make sense, right? When the numbers that are being reported to us does not actually reflect the true reality on the ground. That's why here in this video, I'm going to show you 6 charts that will change the way you look at. Because these charts will actually tell you what's going on behind the scenes. Why the charts that are being reported to us, or the numbers or the statistics, do not reflect the reality. Because look at the inflation rate over the last 30 or 40 years. And you kind of look at it has been stable at around 2%, which is really great. Yes, some years it might be higher than that. For example, in 2022 or 1990. But other than that, it has been around 2%. And wages should increase by 4 to 5%. So if you do the math, the average person should be much wealthier today than he was 30 or 40 years ago. But if we take a look at the real facts, that's not the case. Because it's not always about reporting the numbers to you. It's far more important how you do your analysis. It's far important what you count in your analysis and what you don't count. And it's very easy to lie with these numbers. There's a very nice book that says how to lie with statistics. So if you kind of include the numbers you want and exclude the numbers that you don't want, suddenly everything changes. For example, one of the fundamental things that we have in economics is called a purchasing power. And a purchasing power basically means what a dollar can actually get you. So if you have in your pocket $1, and if you had $1 30 years ago, it's still that $1. So number-wise, that $1 haven't actually changed. If you kept it in your pocket, if you kept it in a safe in your house, if you kept it in a bank account, you still have $1. Unless somebody steals that $1 from you, you still have that $1. But there is a way for the government to steal that $1 without you actually realizing that $1 have been stolen. Because the number might not have changed, but the power of that dollar shrink dramatically over the same period. Let me give you an example. So, over the last 30 years, the value of this $1 have decreased by 30%. So in 2005, you could have $1 and you could have purchased something. Now, the exact same thing would have cost you at least $1.42. Now, nothing have changed. The exact same thing. So you might still have that $1. You might be still earning that $1, but now you can buy with that $1 much, much less things. Now, of course, you might say that, well, that is how the economy works. That's what inflation is all about. And it makes sense. But what if the inflation numbers they are reporting to us do not actually reflect the true reality? So even though your wages are rising, the inflation is not rising according to the data they're reporting to us. So if you kind of take a look at the real numbers, you suddenly realize that you've been getting poorer all this time. Over the last 50 years, the dollar have lost 83% of its value. So what would cost you $1 in 1975, today worth around $5.86. So if the dollar gonna lose 99% of its value, what is the point of making that money in the first place? Isn't that a good question? This is the chart that shows you about how the dollar has been losing its value over the last, since the inception of the Fed. So back in the days, $1 would worth around $28. I mean, the real value of that dollar. And yes, there was a sharp decline when the Fed was actually created, but during the recession or the Great Depression, as it's called, from 1929 to 1940s, that dollar has gained a lot of its value for a simple reason that whenever there is a crisis and there is a shortage of money, people would go back to cash. But back in those days, there wasn't such a thing when the government will just instantly print as much money as they possibly can. That was not the case, because during those periods, we had something called the gold standard, where every money that we had within the economy was backed by something. But if you just go back and take a look at these numbers, you realize that there is a very sharp decline since then, where the value of the dollar has lost a significant portion of its money. Yeah, this is the point where Nixon took out the dollar out of the gold standard, and that actually kept shrinking the value of the dollar ever since. So if we kind of continue this trend, you kind of come to a conclusion where the dollar over time would worth absolutely nothing. So let me give you how that actually impacts your real life. So if we go to the wages back in 1973, again, I'm not actually going prior to the gold standard. I'm actually taking a look after what happened when Nixon already took the dollar out of the gold standard. So I'm talking about the economy that we have today that was already back in 1970s. So wages back in 1973 were around $7,500. So if you take the wages back in 1970s and you compare them to today, you kind of instantly make the judgment that we actually got wealthier. Look at the numbers. The numbers make the true sense. But don't rush, because that is where the actual trick comes in. So the average wage per hour was around $3.6. Now, if you come back to 2023, it's something between $65,000 to $72,000, and it really depends which numbers are you taking. But I'm actually gonna take the highest numbers just to make sure that I'm actually doing it safe, because some people might say, well, it hasn't actually increased to 66, but rather by $72,000. So let's just be very generous and say that yes, the average wages have increased by to $72,000. That makes it an increase of 848%. So 848% sounds really great. The average American over the last 60 years should have actually got wealthier by 848%. And if you look at the state of the economy, if you look at the GDP, if you look at all the numbers that are being reported by the government, it actually looks like you should have gotten wealthier by 848%, because there isn't a single country that grew so much as the United States. But if I would ask you to be honest and tell me, did you actually get wealthier this much? Now, I can tell you for a fact that most of you, or 99% of you, or all of you will tell me, nope, absolutely not. And if you're young enough not to be able to answer this question, go and ask your dad. I can tell you for a fact that he will give you the exact same answer. Because there is one thing that we call wages, and there is another thing that is called real wages. And real wages mean that we have factored in inflation. Remember the purchasing power of the dollar, and the dollar have been losing its value over time? So what happens if we factor that factor as well? Suddenly you realize that the real wage back in 1973 per hour was $26. And in 2023, it is $34.5. So that makes it a real increase of 32.7%. So the government wants you to believe this number, but the reality is this number. Do you see the first problem? So 848% versus 32% over a period of what? 60 years or 70 almost years? Well, you might say that the economy still grew, right? But did the economy grow by just 32%? Well, I guess not. Something doesn't actually add up. But what if I told you that even this number that you see here on the screen is not accurate? Well, before we get into the conclusions, let's just get deeper into the numbers. And that's what we have to include: inflation. Now, if you've been watching this channel for some time, or other YouTubers who make finance videos, you already have an understanding what inflation is. And inflation basically means that prices rise every single year by a certain percentage. So if we want to know the real wages, then we have to take that number and adjust it to the wages, and then we find out that the real increase was 32%. But have you ever asked yourself a question: how do they calculate inflation in the first place? Isn't that a very good question? And logically, you might say, well, they might actually simply take the prices of the last year, compare it to the prices of this year, and that difference is the inflation percentage. Well, that was the case back in the past, back in 1950s and 60s and probably even 70s, I guess. But then they realized that it's a problem. Because if we count inflation like that, then inflation is not 2%, it's not 5%, it's not 10%. Suddenly the real inflation will reflect your real life, where your expenses are rising by 20%. So we should have an inflation rate of 20%. What does that tell you about the state of the economy? And that is why, if you look at the chart, this is inflation report from 1960s to 2020s. And during this period, we had very, very high inflation. And it makes sense because this was the period where Nixon took out the dollar out of the gold standard, which was the first inflation spike. The second problem was when there was a serious oil crisis, and energy prices reflect or impact the prices of everything. You want to ship something from one part of the world to the other, there are going to be energy costs, fuel costs. So if fuel costs suddenly increase by 10 times, they will directly impact the prices of that goods, which is why we had high inflation. But if you give it a closer look to this chart, you kind of realize that starting from this period, inflation kind of got down to less than 3% for a very long period of time, except this spike that happened in 2022 and 2023. So let's ask ourselves a very simple question. What exactly has happened? That's the first question. And the second question we want to ask ourselves is that how exactly do they calculate the number of inflation that is being reported to us? Well, this is where the problem actually comes. So back in the day, they realized that inflation is extremely high. So they decided that let's take out house prices out of inflation. So if house prices are rising so much, they are not factoring in within inflation. And let me tell you why is that a problem. If you take a look at your spending, if you take a look at all of your spending, at least a third of your spending goes into housing. Either we are talking about rent or we are talking about your mortgage. Or if you are looking to buy a house, you couldn't buy a house last year and you're buying this year, and you're looking at prices, and prices have risen by, for example, you've been looking into a certain type of a house and the price of that house have grown by 20%. They don't include that within inflation report. Isn't that strange? One of your main categories of spending is not being included in the inflation report. So if you go back to 2020 and 2021, inflation was less than 2%, but house prices grew by 18 or 19%. It doesn't make sense. The reason they want to do that is because if they include that within the inflation report, suddenly inflation is no longer 2%. Suddenly it's 10%, 15%, 20%. Now another thing, because if you look at another thing that you have to include is that energy prices. If I would ask you, what are your main expenses? I can tell you for a fact, especially in the United States, where it's mostly where everybody has a car, there isn't really a very advanced public transport. Now, if you go to Europe, within the European Union, you have a lot of trains. You can take the public transport within the city. If you go to Madrid, Barcelona, Paris, Amsterdam, you have very advanced public transportation. And even if you go between the countries, you still have high-speed trains. But that's not the case in the United States. Everybody has a car. Everybody drives a car. In most of the states, without a car, there is no life. You can't move around. So most people spend a big chunk of their income on fuel. So if fuel prices increase by 50%, 100%, or in some cases by 200%, they're not being included in the inflation report. So your house prices are not included, your fuel prices are not included, and because when energy prices rise, your electricity bill rises, but that's also not included in the inflation report. What does that tell you about the state of the inflation report that they actually report to you? And that's why you take a look at prices, they have increased by 20%, by 50%, but the inflation report is just 2% or 3%. Another major change they made to it is to move from arithmetic to geometric back in 1999. And that's why inflation stabilized back in 1999 and haven't actually grown that much. And if you're asking yourself, what exactly does that basically means? The Fed and the government realized that when prices rise, you start switching to different alternatives. Let me give you an example. You used to buy a lot of beef, but beef prices have now risen so much that your income or your wage, your salary, your paycheck does no longer allows you to keep buying beef. And because you have no money, you're going to buy something cheaper because you need to eat, you need food, you need protein. Instead of buying beef, you start buying chicken. And chicken is cheaper than beef. Now, beef prices have, let's say, increased by 100%. Because you switched to beef, the inflation report will say that, well, they will not include beef within the inflation report because you no longer buy beef. But you no longer buy beef not because you don't want beef, but because it's simply too expensive. And that is what we call moving from arithmetic to geometric. So, for example, beef prices have been rising since 1995 from $1.4 to around $6. But we don't include that within the inflation report. And this is just one example. Because inflation report simply takes a bunch of goods and then they will say, look at the prices. So as people get poorer, now as prices start rising and people start switching to cheaper and cheaper alternatives, for the inflation report, prices haven't grown. Because if beef prices grown, chicken prices haven't grown, we're going to stick to the chicken because now people have less money. So in practical terms, people actually got poorer. But in inflation report, people did not get poorer. So the economy got bigger because prices have risen, but your wages and your quality of life hasn't. Do you see a problem? One more example. If you take a look at cars, people usually drive cars to work, to school, to everywhere else. And primarily in the United States, or now that's the case pretty much everywhere across the globe, people finance their car with a bank. If you want to buy a $50,000 car, you don't have $50,000 because you are making $50,000 annually. So you're going to go to a bank and you're going to get the loan to buy that car. And if you look at the statistics, you realize that around 80% of all the new cars being financed by a bank. So what the bank is going to do is that they will provide you with that loan, and then you buy that $50,000 car, and then you make the monthly payments. So interest rate that is being set by the bank is going to directly impact the price of the car that you're buying. So if a car costs $50,000 and you have interest rates of 5%, let's just hypothetically take an example. Let's just come out with the numbers. At 5% interest rate, let's say your payments are every single month $500. But at 7% interest rate, now your payments are $600, which is a 20% increase. But it's not going to be included within the inflation report because inflation report does not include interest rates. So your wages, so now let's ask ourselves a question. Real wages have increased by 32%. The real wages after counting in inflation. But the way they count inflation is not really accurate and does not reflect the true reality. So if we actually include within inflation house prices, energy prices, and we don't actually kind of switch to cheaper alternatives and take the prices of things we used to buy in the past before actually prices skyrocketed to the roof, do you think that real wages have increased by 32%? They might actually have gone down over this period. I don't know the math. I have not done the math. But if you think about it logically, even this 32% increase in real wages since 1973 does not actually looks legit. And that's another problem with the wages and the numbers and the reports that are being told to us. But that's not all. This is just one out of aspects. Because what has been happening over the last 100 years is that asset prices have been rising dramatically. So wages have been going down all this time, but the economy has been growing. And that makes no sense. How wages go down, but the economy grows? Something should be inflating that economy. Something should be the driver behind the rise of that economy. So if the size of the economy back in 1990s was around $5 trillion, and now it's $27 trillion, and wages haven't grown, something else have grown. And what has grown over this period dramatically is what? Asset prices. And that's what the real wealth actually is. Let me give you an example. So in the year 2000, the average wage was around $32,000. Now in 2023, the average wage is around $66,000 according to some reports. According to other reports, is around $72,000. So if we take this growth and we find out the real growth, it was around 18%. And if you adjust it for every single year, then the real growth of wages since the year 2000 was less than 1%. I mean, just take 18% and divide it by 25, and you have like what? 0.7%, 0.8%. So your real wages have grown by 0.8% over the last 25 years. And now let's take this and compare it to asset prices. One of the major categories of assets are stocks. And if you look at stocks, for the exact same period, they have grown by almost 700%. So wages have grown by 18%, asset prices have grown by 700%. Do you see what exactly is driving the economy? Do you see who exactly is getting wealthy within this economy? Do you see who is benefiting from the rise of the US economy? Do you see why people, even though that the US is the wealthiest country in the world, the average American is not living like a king? The average American is not enjoying this lavish lifestyle, but rather, if you take a look at all these numbers, the average American is living paycheck to paycheck, does not have even $1,000 of emergency fund, and is barely paying his bills. This is why. Let's take another example. If you take a look at house prices, the median house price back in 1973, it was around $35,000. Is that a lot? Well, compared to today's numbers, buying a house for $35,000 is absolute peanuts. But back in the days, the average salary was around $7,500. And now if we go back, if we come to today, which is 2025, it's around a little over $500,000. So house prices have increased by 500%. But wages during the exact same period have increased by 32%. And I went a step forward and made the math. If we include the real inflation, if we include inflation within this number, what was the real growth of house prices over the exact same period? And it's 122%. So the real increase in wages was 32%, but the real increase in house prices was around 122%. Do you see the problem? Do you see why we live in a society today where the average person with an average wage have no chance to buy a house? And if you take a mortgage, you can barely afford a mortgage. And if you even take it, it is a nightmare to pay it off over the next 30 or 40 years. And this is the problem, because asset prices are dramatically rising, are growing all over the roof, while wages are stagnating over time. And the question is that who is holding all of those assets? Because this chart is much worse than the charts that I have actually showed you, because most of the assets are being held by the top 10%. This is wealth distribution within the United States. And if you look at these charts, you quickly realize a very simple pattern. The bottom 50% of Americans hold around 2.5% of the wealth. Think about that for a moment. The US population is a little over 300 million people. So it's around 320 million people. If you take 50% of those people, that's around 160 million people. So 160 million people within the United States hold around 2.5% of America's wealth. So if you're wondering why the average American is not living like a king, despite the fact that the United States is the wealthiest country that has ever existed, this is your answer. So who is holding all of that wealth? If you think it's the top 10%, that's not entirely accurate. Yes, because the top 9%, or if you exclude the top 1%, held around 36.5% of the wealth. The top 1% holds around, if we don't include 0.1%, holds around 16.7%. And the top 0.1% holds around 13.5%. So, a very small minority of people, which is 0.1%, not 1%, not the top 10% or the top 1%, but literally top 0.1% holds 13.5% of all the wealth. So this very tiny small minority of people holds like 6 times more wealth than the bottom 50% of Americans, which is 170 million people. And then we have the top 1%, which holds 16.7%, and the top 9%, 36.5%. And the middle class, the people who are between 50% to 90%, hold around 30% of the wealth. So if you kind of think about it, the top 1% of Americans control around 75% of all the wealth, or 70%. And the 30% is controlled by the middle class. And then the bottom 50% is barely surviving and has no money at all. So when we talk about the US economy is growing, when we talk about asset prices, when we talk about asset prices are growing, who is getting wealthier? That's the question you should be asking yourself. So the top 1% holds around 50% of all the stocks in the United States. The stock market is the main source of wealth in the United States, or the US stock market is the main source of wealth around the globe. There isn't such a high concentration of wealth anywhere else in the world other than US stock exchanges, primarily the New York Stock Exchange or the NASDAQ and a couple of others. So the top 1% of Americans owns 50% of all of the stocks. That is equal to $25 trillion. Do you see why there is so much wealth inequality? The top 10% holds around 93% of all the wealth, which is $42 trillion. So 10% of the people in the United States own 93% of all the stocks in the stock market, and everyone else controls the rest 70%. Do you see who is actually benefiting from the rise of the US economy? It's not the average person. It is not the average employee. It is not the middle class. It's not none of those people. It's not even the doctors, the engineers, the lawyers who are making really good money are not benefiting from the rise of the US economy. They're still living paycheck to paycheck. They're living a pretty decent life compared to most of the world. But other than that, the people who are winning from the US economy, who are winning from the fact that the US economy is growing by 100%, 200%, 1,000%, these are the people, the top 10%. The bottom 50% of the US population holds absolutely nothing. Those 2.5% of the wealth they have is nothing. Maybe some cars, maybe some real estate out there, because they own nothing out of the stock market. So you quickly see a pattern that bottom 50% holds nothing in the stock market. They don't know how to invest. They're afraid to invest. They're afraid to teach themselves to learn how to do that. They don't have the right tools, so they keep in that cycle of poverty. Their kids will come out. Yes, there is a percentage of those people will get out of the poverty. But most of those people will never get out of this poverty because they need to go where the real wealth is, which is the stock market. The top 1% owns 10% of the properties. The reason that the bottom 50% or the middle class at least has some wealth, because if you take a look at the numbers, they have some wealth. Where that wealth is coming from? Real estate. So if you go and get a mortgage, which you can easily do in the United States, you can get a house and you have some wealth. If you're poor, you still can get a mortgage if you kind of build up your credit score, if you get a decent job to a certain extent, you can get a mortgage and you can build some wealth. But that wealth is just enough for you to stay above the waters. This is not the kind of wealth that is going to make you rich. Because what makes you rich is there in the stock market, and 93% of that is held by the top 10%, and you're never going to get there because you're busy with other things. You don't even know how to invest in the stock market. You don't even know how to pick the right stocks. How are you supposed to go there? And nobody teaches you that in school. No one teaches you that in college, in university. And if you haven't even gone that, then your chances are much lower. And if you're a lawyer, engineer, or doctor, then you're probably focused on your work. You don't have time for that. Yet, yes, you're making good money. Yes, you are paying the bills, but you're not benefiting from the rise of the US economy. So every time the Fed prints money, what do you think is happening? Asset prices are rising. And what are the asset prices? Stock market and houses. Primarily the stock market. House prices grow as well, but nowhere close to the stock market. So if you already have a house, for example, if you have purchased a house in 2020, 2021, you have benefited from the rise of house prices. But if you have invested in the stock market, you have benefited enormously. Because the biggest losers of the Fed's printing machine are the wages. So wages have gone down. Even if you're in the top 1% and you're making a lot of money, your real wages have gone down. If you are a billionaire, a millionaire, it doesn't matter. Your wages probably have gone down, but you don't care because you look at your stocks and you know that your wealth have grown from that printing machine anyways. You're safe. But the average person who has, but 93% of the people, but the vast 90% of the people who held no stock at all are not benefiting from that. Do you see the problem? And that takes me to the next point, which is wealth inequality is actually rising tremendously. Now, if you're saying that, well, why are you complaining about that? Now, first of all, I'm not complaining, I'm explaining. Now, secondly, wealth inequality has not always been this bad. Yes, if you go a few hundred years ago and we had a lot of monarchies all across the globe, I think if I'm not mistaken, right before World War I, we had a lot of monarchies and there was a drastic wealth inequality. So on one side you have kings and you have people around the king. So these are really wealthy people. And then on the other side, you have the average people. Usually these are the slaves. Usually these were, something related to slaves or the average farmers. So they did not have the opportunity to actually get rich. So their kids would actually also become slaves or farmers. And that was the thing throughout generations. But we no longer have that system. All across the globe, we have capitalism where people can actually start working and they can actually start, and things fundamentally changed. And that was the case in the United States because the United States never had any kind of monarchy. When the US was established, it was a former colony of Great Britain where Britain was a monarchy. It did not want to become a monarchy, and it had a presidential system with a capitalistic system that granted people an opportunity to actually build wealth. And that's why the wealth inequality that we have today was not always the case. Let me show you the numbers. If you look at this, the wealth distribution of families, of wealthy families, 1963. So you can see that, yes, this is the top 10%. Now let me just change the colors, that would look better. This is the top 10%. And yes, the top 10% compared to everyone else is wealthier. No doubt about that, no questions about that. And the top 10% and the top 1%, look at the top 1%. This is the top 1%. They are living far better than even the top 10%. And if you compare them to the average people, they live significantly much better. So I'm not going to tell you that wealth inequality did not exist. But the main question is that how much wealth inequality has changed over the years? Did it increase? Did it decrease? So let's take a look at the exact same statistics today. So these are the numbers for, not exactly today, but for 2022, which is not really that far away. And suddenly realize a massive change. The top 1%, we're talking about like 1%, they instantly got not twice wealthier, 3 times wealthier, they got like, I don't know, probably like 80 times wealthier than everyone else. Yes, the top 10% also got wealthier, but nowhere close compared to the 1%. So if you kind of put these two charts side by side, you suddenly realize that we are back into the monarchies. We are back into the world where we have a very tiny minority, which is the king and everybody around him, living a completely different life, having all the wealth in the country, and then we have like the bottom 90% who are simply living paycheck to paycheck. We are literally going back. We're not going back to that kind of a lifestyle or society. We are already in that society, given the facts and the numbers that we have here. And because things doesn't seem to improve over the next 20 or 30 years, the situation is going to get worse. But I have no idea how much worse it can possibly get because it is already bad. It is already in such a dire situation that most people literally have no chance to escape. And this is not going to change. And you're asking yourself why exactly that is the case. Why exactly do we have, how did we end up in a society where the top 1% is getting so much wealthier while everyone else is getting insanely poor? I understand the situation 200 years ago, where you had a king that would actually create rules that will keep him in power, or if you were a slave, if you were born into slavery, or if you were born into a farmer's family and you had no chance to escape that, I would understand that, because getting out of that would have cost you your life. But how is that even possible in a capitalistic, free society we have today? No matter how you look at this, it makes absolutely no sense. How did we end up in such a situation? How we ended up in such a society? People had free will. People are smart. People have brains. People can see the logic. People can think for themselves, and they can see that, well, if this is the path for wealth, maybe I should be taking this path and not this path that is going to make me poor. Does that sound logical? Well, unfortunately, people don't think like that, even though that is the logic. Because there is something called in this world that is called compound interest. And compound interest is literally a law or a rule, whether we have kingdoms or we don't have kingdoms, whether we have whatever society we have. This rule, the compound effect, is going to play its role whether you want that or not. And that compound interest have been making the wealthy people wealthier and the poor people even poorer. Let me give you an example. If you invest $1,000, if you start with $1,000 and you invested in the S&P 500 and you get an average of 10%, and you're just going to invest a monthly income of $100. Now, $100 in the United States to invest is nothing. Like, everybody watching this video can afford that. Like, everybody. I don't care what job do you have. Even if you're like 20 years old, even if you're a teenager and you're working, you can get $100 a month and you can invest it. So if you invest $100 a month, what do you think is going to happen to that $100 over a period of 50 years? It is going to grow to 1.8, or I would say even, it's almost like $1.9 million. How do you go from $100 to $1.9 million? And if you increase that slightly, maybe by $10, it might have actually grown by $2 million. So if you think about it from the rational perspective, even $100 can turn into almost $2 million if it has been given enough time. But most people think within a short period of time. Most people think about making money today. Most people think about making money tomorrow. Most people think within maybe the longest period time that they think about is a year. That is period. Nothing longer than that. But the changes we talked about in this video are about changes that happen over a long period of time. So if we go back to 1973, rich people had an X amount of wealth and poor people didn't have that wealth at all, and they started with that. So rich people, even though they did absolutely nothing, but they actually kept their money invested in the right assets, it kept growing, growing, growing. So today, in 2025, when I'm recording this video, that change is growing so much where we are living back in a society where the top 1% is controlling all the wealth in the world, where everyone else is poor. Now, what people are going to do with this thing? Most people watch with this video and they will get excited, but tomorrow they will forget about it and nothing will fundamentally change. But the people who want to escape this poverty and they want to go from being this in the bottom 90% to the top 10%, they will ask themselves a very simple question. What exactly are these rich people are doing? Well, they are investing. They're investing in the stock market. They're investing in the right assets. They're buying this kind of stocks. And over time, that gap is growing and they're thinking long term. So they will get rich not tomorrow, not next year, but in 5 years, in 10 years, maybe even in 20 years. What I see usually happens with people, because they're living paycheck to paycheck and they cannot invest extra money and the path is so long, they never get there. But I can tell you for a fact that if you just get to your first $100,000, everything else gets easier. Because all you have to do after that is just don't touch that $100,000. You are going to be in that category of people who 20 or 30 years ago had that capital that kept growing on its own. So every time the Fed prints money, that capital keeps growing. Every time the US economy grows, your capital keeps growing, even if you do absolutely nothing. And most people, if they actually follow the right strategies, if they have the right tools in their hands, they can go to their first $100,000. And that's how you build wealth. That's how you join that top 10%. That's it for today. Thanks guys for watching, and I will see you in the next one.